All right, so we'll start with the income topics. Today we'll be completing the income, and then tomorrow we'll be moving to the foreign related topics, foreign income exclusion, foreign tax credits, and everything. Okay, so quickly we'll start in income. We are going to cover about the wage, salaries, other income, special rules for certain employees, where we are going to understand clergy related income. Those who are a church employees, for them how the income will be taxable. Interest income, dividend income, IRA we have already covered yesterday. So that is the part where you are going to get a distributions at that time when you include it in the income. It is related to this. Okay, social security benefit also we have done it yesterday. Then we'll cover rental income, business income, and some additional incomes. Okay, so let's start quickly. Wages, salaries, and other income. If you are earning a wage income, then whether it's going to be taxable in your tax return or not, being an employee, it will be included in your gross income. Okay, an employee should attach copy B of form W2 to the federal tax return. Okay, the employer, when they are going to pay the wages to the employee, obviously they will be reducing certain taxes in the form of payroll tax and all, right? So employer is going to file a W2 form with IRS. They'll give you one copy, copy B. Copy A will go to the IRS, copy B will go to the employee from whom the payroll taxes are deducted, and the copy C will be retained by him for the future records. Okay, so being an employee, it will be included in the gross income. Employee should attach a copy B to the W2 form, and if they receives 1099 NEC, this we have already seen in the class, that if you are a statutory employee, right? If you remember, statutory employee, we had 4 conditions plus 3 categories, right? What were the 4 conditions? If you are a driver and you are distributing the beverages except milk, right? If you are a life insurance policy seller, right? Insurance agent, you are a city salesperson, right? All those 4 types of categories we have already seen. If you fall under any of these 4 categories, you are going to call as a statutory employee if you fulfill 3 conditions. You don't have any personal investment. All the materials and everything, substantial investment is of employer, not of employee, and you are performing the whole services on your own. That is what we called as a statutory employee, which we have already done, and in your book also I think there will be some definitions mentioned. So when you are going to receive a W2 form as an employee, you include it in a gross income. Okay, second thing is employee should attach it to the copy B of the W2 to the return. Third thing is, if you receive a 1099 NEC, it will be a non-employee compensation. It will be reported by the employer to the employee, but employee will not include it on the W2 form, but it will be included on the Schedule C as a income. What is Schedule C? Schedule C is related to the business income, right? And because their employer did not consider them as an employee, they might have not deducted the social security or Medicare. So for that type of particular treatment, you are going to file a form 8919 to report uncollected social security and Medicare taxes on the wages. Because you are not an employee, they might have not collected the social security, Medicare. So you will be filing a separately, mentioning it separately in a tax return in the way of 8919 form. Okay, employer will be reporting the annual employee compensation to the employees on form W2, as I mentioned. Okay, if you are going to receive any scholarship or fellowship grant that were not reported taxpayer on W2 but now reported, it will be now reported on Schedule 1. Okay, some scholarship and fellowship grants or anything which have been provided but which is not mentioned on your W2 form will be reported on the Schedule 1. Okay, Schedule 1 will be regarding the additional incomes which are not mentioned on the page 1 of the 1040. Okay, next is childcare provider. If you are providing the services of a childcare facility, daycare facility, right? So being an employee, you are still going to include it in the gross income. Being an who are not an employee must include it as a Schedule C, as a business income. Let's say you're working in a childcare facility as an employee, you will be receiving the W2 from them, you will be including on the gross wages. So the basic idea is what? When you are going to receive a wages, a salaries, or any other earning from your employer, you are going to include it on your 1040 return as a wages, as a taxable income, gross wages. Okay, next is foreign income. Foreign income, when we do the tomorrow's topic, when we are going to take this foreign income, earned income exclusion and foreign tax credit in detail, we'll understand over there. Right now, I'll just tell you the basic thing is, when you're residing in US and if you are a US citizen, okay, if you're a US citizen and you are a resident alien, right, and if you are having a earned plus unearned income, then in that case what will happen, all the world income will be taxable if you are residing in US and you are a US citizen. Then you should report all income, including any source within US, any source outside US, all will be included in the tax return. But let's say you are a US citizen, you are a resident, you are not a resident, you are residing outside US, then you may be able to exclude certain part. So this is what we will refer to as foreign earned income exclusion. This will do tomorrow when we do the foreign related earnings topic. Today we are going to just focus on gross income, all the earned and unearned income. I'll cover it quickly. Okay. For this foreign income, we'll take a wholly different session tomorrow, in which we'll also see that how much credit will be applied on the foreign taxes which you have paid. Okay. Next is advance commission. Advance commission means what? Let's say in current year, I am going to receive certain commission, but which will be used, my performance of the services will be done in the next year. So if I am a cash basis taxpayer, now what I will do, I will be including whatever advance commission I have received in the year of receipt. Okay. So this will also be your earned income. This all right now what we are learning is all your earned income. You have to understand the difference between earned and unearned, because in certain topics you will have the different criteria. Okay, cost of living allowance and reimbursement. Say it happens that the employer is going to provide some cost of living allowance to their employees. Okay, so if it is provided to the employees and the incentive is for taking a less desirable assignment as a part of compensation, it will be included in the income. Okay, or any other reimbursement which is being provided by the employer, let's say living expense or any XYZ expense which is for living allowance which has been provided by the employer to the employee, will be included in the income. There is no exception. Any benefit which employer is going to provide to the employee will be included in the income of the employee. Gross income, it will be added. Okay, but there is one exception. If you are a federal civilian or a federal court employee, where you are stationed at is where you are working in Alaska, Hawaii, or outside the United States, and while working over there, the reimbursement and living allowance are provided to you by the employer. If this thing happens, then only it is allowed as a exception, like it will not be included in income. Remember this exception, only this type of employees, federal civilian, federal court employees stationed at Alaska, Hawaii, or outside United States, for them, if you are going to receive a cost of living allowance or any reimbursement from your employer, then it will not be included in the income. But rest all employees, if you are living in normal, like in United States only, you receive any living allowance from your employee, it will be included in your income. Okay, for any other type of employee, here it is mentioned, it will be included in income. Okay, next is back pay. Back pay means what? Let's say I have incurred certain amount, I have provided certain services but yet not received the income or received a lesser income. In, let's say, next year I am going to recover my wages and salary which was not paid in the previous year. So it is a back pay. This includes payment made to a person for any damages, any unpaid life insurance premium, any unpaid health insurance premium. So any this kind of payment which has been paid by the employer to the employee, any damages or any unpaid amount from the previous income, right? If it is received by the employee, it will be included in the income. For employer, what will be the treatment? They will report it in the W-2 form and taxes will be deducted. Actually, it is a payment, right, from employer to employee. So it will be included in the W-2 form, taxes will be deducted, and for employee, it will be included in the income. Back pay is nothing but, just remember, like any previous payments which are now being made. Okay, it's called back pay. Next is bonuses and awards. If employer is providing any bonuses and awards to the employee, it will be included in the income. Okay, then if the award is for good or for the goods or services, instead of providing some cash, you provide you get a amount in kind. Okay, then in that case what will happen? it will included in the income. The fair market value of that particular goods or service will be included in the income, and the employer will be showing it as a W2. Now here one exception we will see is prizes and rewards. Okay, prizes and rewards are the kind of thing where if you receive a prizes and the rewards once in a 5 year, okay, once in a 5 year, if an employee is going to receive the prizes and the rewards, then it will be excluded. Okay, so there are certain exceptions we'll see later on, but this topic is talking about bonuses and awards. If you receive certain bonus, right, let's say overtime bonus you receive, or some reaching an extra mile, if you receive a bonus, reaching an extra target, you receive a bonus from your employer. So any benefit, as earlier I mentioned, any benefit which is received from the employer will be included in your this tax return and in your W2 form. Okay, severance pay means what? Any back pay kind of transaction only, but I can say if you have an unpaid leave of let's say 12 days, but in current year you have utilized only 6 days as a leave, okay, but so remaining 6 days, whatever is left, it has been carried forward to next year, or the second option is you can take a compensation which is equal to the 6-day payment, right? This is called as severance paid. So any amount, this includes any payment which is received for accrued leaves and monies withheld from the severance for the outplacement services. Okay, any accrued leave, or if any money is withheld from the severance for any outplacement services, these two kind of payments are called as severance pays. Same line, I'll repeat again, any benefit which is given by the employer to the employee in the form of cash or in the form of kind will be included in the income. So include any income due to cancellation of employment contract. Let's say we have some contract and due to the cancellation, maybe employer is going to pay me certain amount, for example. Okay, so income due to cancellation of employment contract must be included in the income. Okay, include the unreduced amount of severance pay in the income. What is unreduced amount, guys? Whatever is the gross pay will be included. Any taxes, withholding, or everything which is deducted will not be considered. Any severance pay means the 6-day leave you have not taken, so for that you are taking the equal compensation for that 6 days. Okay, that will be included in your income. Got it, guys? Now this is important one on sick pay. A lot of questions are asked. Sick pay, disability income will be asked, tip income. These are the important whom I am marking as important. Please make sure you guys read it very well and in detail from your regular book. Okay, sick pay is taxable, means it will be included in the income. It will not be taxable only in the situation where employee paid the premium on accident and health insurance policy. Only on these two policies, accident and health insurance policy, if you are going to receive a sick pay, let's say you are sick and you are going to receive a payment from an insurance company. Now you have to check that insurance company's premium was paid by whom. If employee himself is paying the premium, then it won't be taxable, right? Let's say a company X and company is an insurance company, and for Mr. A is the employee, right? This person has taken his own insurance, right? And now he is sick, he is taking the medical reimbursement from the company, right? So in that case, what will happen? Whatever premium which he has paid, now up to that amount it won't be taxable. But let's say instead of Mr. A, his company has paid the premium, right? His employer has paid the premium, so whatever reimbursement he is going to get, the sick pay which he is going to take from the company, it will be included in his tax return as a wage income, as a sick pay. Okay, but sometime what will happen now, both the employee and employer has taken certain insurance policy, right? So what will happen, only the portion you have to divide it into two parts. What is the employee's portion, what is the employer's portion? Whatever is the employee's portion, it will not be taxable. Employee's portion of premium, let's say employee is taking $100 as a premium, employer is paying $100 as a premium. Now when you take a sick pay from this insurance company, you took a $5,000. okay, so can I say $2,500 that was pertaining to the employee share, like 50% of a premium was paid by employee, that will be not taxable, and 50% which is paid by the employer, that will be taxable. Okay, and when I say taxable means it will be included in wages. Today, right now, we are learning all employee related incomes. Okay, so employee must include the income, sick pay benefit received from any of the following payers. Who can be the person who will be paying is welfare fund, state sickness or disability fund. Okay, they can receive the sick pay from the welfare fund, from a state sickness or disability fund, from an association of employer or employees. They might have created an internal associations. From them, if they are going to receive it and the premium is paid by the employer, then it will be taxable. Any insurance company, if employer paid for the plan, if employer is paying for that plan to the insurance company, and if they are taking the sick pay from that insurance company, it will be taxable. Okay, got it guys? Sick pay is important. I'll repeat again myself. Next is disability income. Again, this one is important. Disability income means what? Let's say the person has become disabled, right, due to any reason, due to reason of any, let's say, of a worker is working in a factory or any manufacturing unit, and due to the work condition he became disabled. Okay, then when he is going to receive the disability income at the time of this disability, when he is going to receive certain income, same treatment which we saw in the sick pay will apply over here. Means if employer is paying for the plan, employer pays the plan premium, then it will be taxable. But if employer is not paying, employee himself is paying the premium, then it is not taxable. And if it is partially paid by both of them, employee and employer, then partially will be taxable. The taxable will be only the employer part of premium. As I mentioned, whatever benefit the employer is going to provide to the employee, everything should make taxable to the employee, right? So here the portion of the employer will get taxable in the employee's tax return. The portion of employer's premium which employer is paying. Okay, non-taxable portion is what? Employee's part of premium. Okay, so you'll have to proportionate both of them between the employer and the employee. Non-taxable is what? Reimbursement for medical expense incurred after the plan was established. Now let's say the plan has already been established. Later on, the reimbursements are done of medical expense. Let's say I have incurred a medical expense on 1st of Jan. The plan has established on 31st of Jan. Means this insurance policy plan by the employer is established on 31st of Jan. So whatever this medical expense I have incurred, my employer will be reimbursing it to me later on, right? So this reimbursement was done after the plan was established, but the expense I incurred was before the plan. Okay, so this will not be taxable even though the employer is paying me. I know employer benefit, anything which is given to the employee is taxable, but since the payment is made after the establishment of the plan, it will not be taxable. Okay, next is taxability. We have already seen if the employee is getting any amount in the form of disability income and the premium is paid by the employer, then it will be taxable. Okay, same way sick pay, disability pay, we have accident or health plan. If it is covered by the employee, okay, then it is not taxable. But health coverage provided by the employer, it will not be included. Provided by the employee, provided by the employer. This is an important, you'll have to remember. In case of sick and disability income, what was the case? That when it was included, when the premium was paid by the employer, it was included. Here, in case of health accident plan, health or accident plan, see here what it is? Disability income. Here it is sick pay. Okay, here it is health or accident plan. If it is provided by employer, then also it is not going to be included in the income. Accident or health plan, remember the word. Okay, benefit received from the plan may be taxable. Means, can I say when the employer is paying the premium, this premium will not be taxable, but when the person is getting met with an accident or due to any health related plans, when they are going to receive the benefit, it will be taxable. Only the benefit. Okay, let's say the premium was $100, but when he received the benefit of $1,000, so 1000 minus 100, whatever is the 900, the extra benefit which he is receiving, okay, 100 was the premium, that is the cost. This is the amount which he is going to receive from the company, insurance company, right? So whatever is the remaining extra benefit which he is going to receive will be taxable. Got it, guys? Next is fringe benefit. Fringe benefit will be included in the income. Whatever are the small benefits which are given by the employer to the employee will be included in the income. It will be excluded only if excluded by the law. Excluded by the law. And if the employee paid the fair market value of the benefit. Let's say I have received a certain benefit from my employer and I am paying him certain amount, FMV, or a lesser amount if I pay. So whatever extra benefit which I am getting from him will be included in my income. That is fringe benefit. Or I can say, let's say my employer has restricted me to perform certain services under a certain agreement, right? Compete agreement. It is called as abstaining from performance of a service under a convenient not to compete. Okay, will be treated as a performance of service for the rule. Means whatever extra amount which I'm going to get for non-performing of the services, that amount will be included in my income. Okay, that is a fringe benefit received in connection with the performance of service or for not performing services. Both will be added as my income. Okay, so the next one is group term life insurance policy. This is important. Whenever a insurance is taken by the employer for all the employees, let's say a group of 10 employees, the employer has taken a life insurance policy or a term life insurance policy for, let's say, 5 years, 6 years. Term life means what? For a particular certain number of years, right? And the coverage of this all 10 employees is within 50,000. Then it will not be included in the employee's income as a benefit. See, any benefit given by the employer to the employee will be included in the income, but because it's a term life insurance and if it is within 50,000, then it is not going to be included in the income. Okay, got it, guys? But if it is more than 50,000, this coverage 50,000 means what? The cost incurred by the employer is more than 50,000, then it will be included in the income. There will be 2-3 tricky MCQs based on this group term life insurance policy. They will provide you the whole amount of coverage, right? And let's say 10 employees are there, and if the amount of coverage is more than 50,000, you will have to check what is the cost. What is the actual cost which employer is incurring for the employees? Okay, and then find out the amount. See, here it is mentioned taxable amount is coverage amount minus amount paid to purchase it. See, coverage is different thing, premium payment is different thing. Okay, so if the coverage is more than 50,000, let's say only $1 lakh has been covered. Okay, but the cost of taking this coverage is just $80,000. Okay, so this $80,000 is the cost which will be added to the employee's income. Remember this thing. Okay, so in MCQs, make sure to solve it accordingly. Don't take the whole 1 lakh and divide it by 10 employees. Take 80,000 and divide it by 10 employees. Okay, it is provided by the employer or the former employer if employer must report the amount on the W2 form. Okay, means if it's a taxable coverage, when it will be taxable? If the coverage is more than 50,000, then you'll have to include it on your W2 form. Then we have employer paid premium for whole life or permanent insurance are included on the employee's income. Okay, if employer paid the premium for the whole life, let's say employer has taken the employee's insurance premium for the whole life, not for the term life, not for the fixed life, for the whole life, or their permanent insurance are included in the employee's income. It will be included in the, there you will not check the coverage and everything. If it's a term life, then only you will check whether it is less than 50,000 or more than 50,000. If the whole life is covered for the employee, the whole amount will be added in the income. Okay, got it, guys? Next is restricted property. Here we have done this thing very well in the class. Whenever the employer is going to provide some property, stock, securities to the employee, and there is a restriction that the employee will not be selling this thing, this shares or securities, this property in the market before completion of the 2 years. Can I say there is a lock-in period to sell that particular security? In that we have done 83B election. Okay, I'll come to it. Restricted property will be taxable in the year of grant date. Let's say in 2022 it has been granted. It will be included in the income. What will be the income? That is the FMV of the property received, year of grant date. But it will be taxable in the later year if it is a restricted property. If you receive a property which carries some restrictions, let's say they have restricted 2 years, like after 2 years the property will be can be sold or can be utilized for some other purpose. Okay, then it will be taxable in the later year substantially when you vest the interest in that particular property. Okay, got it guys? But here the exception is, see what will happen when you record that property after, let's say 5-year restriction is there, and that is appreciated property. Let's say you receive a building or any other land or building you receive, and after 5 years when you check the value, now it is going to be increased very on a very higher side. So at that time when you're going to increase the FMV, it will be a very costly, it will be a very huge loss for the employee, right? Because you're receiving in the year 1. So you have the option to go and elect 83B and include that restricted property as income on the date of the grant date. So 83B can election which can be made within 30 days of the grant date. The IRS treats the restricted property restricted stock dividend as a compensation and not as a dividend income. See, let's say you received a securities or shares and it's a restricted property, you cannot sell it, but on this shares and security you are going to receive a dividend income. So whatever is the dividend income, it will not be included as a 1099 DIV. It will be included in your W2 as a compensation because it's on the restricted stock, restricted property. Later on, after 5 years, when you vest that particular shares and securities, when you the restrictions is removed, at that time when you receive the dividend, it will be considered as a normal dividend, normal passive income. Right now it is included in your W2, so it's your ordinary income. Okay, got it guys? Restricted property we have already done in the class very well. Please refer that material again. Next is stock option, most important and the examiner's second favorite topic, stock option. They will ask you few questions on the stock. If you are going to receive a non-statutory stock, that is non-qualified stock, then the treatment is different. And if you receive a statutory stock, that is incentive stock option, means when employer is going to provide some stock to the employee. Let's read about the second one, that is statutory or incentive stock option. Employee will not have any income until they sell or exchange the stock. Okay, let's say employer has granted a particular shares and securities to the employee and there is no restriction, they can sell at any time. But let's say employee is not selling it right now, they are going to sell it in the future, let's say after 3 years or 5 years. Okay, so it's a incentive stock option. Then in that case, employee will not have any income until they sell or exchange the stock. Unless and until they sell it in the future year, they will not have any income or expense. But as and when they are going to sell it, capital gain tax rate will be applicable at that time when they sell it, because this is a normal treatment, right? Shares and securities are liable for the capital gain. So in future year, when they are going to sell the shares and securities, capital gain tax rate will apply if employee holds. Now here the option is you should hold the shares and securities for at least more than 1 year from the date of exercise plus more than 2 years from the grant date. Okay, if these two conditions are fulfilled, then only it is called as ISO, incentive stock option. And if it is incentive stock option, then capital gain rate tax will be applicable, and right now it is not included in the W2 or anywhere. Okay, it's a stock option, and if it's an incentive stock option, employee will include in the income when at the time of sales, and the sales will be done in how many till how much period is more than 1 year from the date of exercise. I'm repeating, exercise word is mentioned. And for 2 years, grant date, from the date of the grant till 2 years you have to calculate, plus from the date of exercise, right? You have given the option by the employer, it's your choice whether you need to exercise or you need to lapse. Okay, so when you exercise it, from that calculate 1 year, from the date of grant calculate 2 years. If you hold the share for at least this much period of time, then it will be capital gain. If you sell before 2 years of the grant date or before 1 year of the exercise date, it will be called as ordinary income. Okay, ordinary income means ordinary rate, tax rates will be applicable. In capital gain tax rate, the tax rates are different. If you remember 0%, 15%, right? That all exceptional special tax rates will be applicable in case of capital gain. But once it is called as ordinary income, it will be added in your normal slab rate. Okay, what is now non-statutory or non-qualified plan? The option is treated similarly to other property. Means you are going to include, when you receive a non-statutory plan from your employer, you are going to include the FMV in your wages income. Okay, include the FMV in the income, and if the FMV is not available, then what you are going to do, amount to be included will depend upon the exercise option, whether you are going to exercise it or whether you are going to sell it. When you exercise it, the exercise price will be taken. When you are going to sell it, the sales price will be like whatever is the sales price or disposal price option, whatever is available, you are going to take it as a wage income in your W2 form. Got it, guys? Now, what do you mean by non-statutory? See, statutory means what? All the policies are same for all the employees, right? For employer, when they are coming out with this option, stock option, they keep the same policies for each and every employee. That is a statutory option plan, incentive stock option. If they came up with a separate standards for different employees, for highly compensated employees, they have different treatments, then for them it is called as non-statutory, non-qualified plan. Okay, this is the way you are going to treat, and this is important, guys. When you receive any question based on this, please make sure you read it carefully, whether it is statutory, whether it is non-statutory. See, why we are doing this in the chat format now, it should be easier for you to figure out from which topic the question is asked. The question will not be asked on topic based in exam. All the 100 questions will be asked from any XYZ topic. So please read the first 2 lines and you will understand that which chart you need to apply in that question. Okay, so this was about the stock option. Next most important is tip income. People actually find a little bit difficult in understanding this topic, but it's very easy to understand. We have just a small technique you have to remember. Whenever you receive a tip income, okay, what is tip income? Apart from wages, if you're going to receive an extra earning from your customers, let's say you're working in a restaurant industry, right? In that case, your customer pays you certain tip, and if that tip is more than $20 during the month, per month, you have to calculate. If the earnings of the tip income is more than $20, then in the next month, let's say I have earned the tip income in the month of January for $25. So in next month, that is Feb, till 10th of the next Feb, I will have to report this tip income to my employer, so that my employer can add it in the wages calculation. Okay, but let's say if it is less than $20, then there is no requirement to report that tip income to the employer, and employer is not going to include it in the wages. But when you file the tax return, let's say I've received tip income of just $10. When you are going to file the tax return, I will have to include this $10 as a income, as a taxable income in my tax return. This tip income just provide you the reporting requirement, whether you need to report it to the employer or not. Okay, when you are going to report it to the employer till the 10th of the next month. Now, what will happen if it's a December month, right? If it's a December month, then what is the due date to report it to the employer? It is 10th of Jan. Now, you have to remember this date in case of December tip, and mostly the question will be based on December month tip only, because most complexities are there in this only. When you are liable to report, when your per month income, per month tip income is $20 or more. When you're liable to report the tip income, right, and you report it before 10th of next month, means before 10th Jan, if you report it, then what will happen? It will be included in the Jan month, means it will be included as the income in next year. Okay, let's say 2022 in December, I received the tip income, but I reported it, I have to report it in the next year before 10th Jan. Okay, so I reported it within time, before 10th Jan, then this tip income will be included in my 2023 tax return. In 22, it will not be taxable. Got it, guys? Now, when it will be included in 22 tax return, let's say I have to report it before 10th Jan, but I reported it after 10th Jan. Okay, so delay in reporting will cause the taxability of tip income in the same year of receipt, which is mentioned over here. See, it will be included, tip income will be included in the income. All the tips received directly, charge tips paid by the employer. What all tips will be included? All the tips which are going to receive directly by the customer, charge tips which are paid by the employer. Let's say all the tips are collected and then they are distributed to different employees. That is also called as tip splitting or tip pooling arrangement. all those tips will be liable for tip reporting. Non-cash tips such as ticket, passes or any other items, based on their value, you'll have to report it as an income. Okay, now what are the records which need to be kept by the employee? Employee, being an employee, when I'm receiving the tip, I'll have to keep the daily tip record, report the cash and charge tips on the to the employers on the 10th of the next month if my wage income is tip income is $20 or more. Okay, if it's a non-cash tip, okay, if it's a non-cash tip, then I don't have to report it to the employer, but it's a non-cash tip, it will be included in the income. See, remember, understand the difference between the what to be included and what is reported in or maintained by the employee, record to be maintained by the employee. While maintaining the record, you don't have to report the non-cash tips, okay, but when you record it in your tax return, you have to include all the tips as an income. Okay, now next is report all the tips on the income tax return. As I mentioned, 1040 return, you'll have to report it, and it should be reported to the employer before 31st December. But let's say if it is reported to the employer after 31st December, will be reflected on the employee's W2 in the following year. But there is one exception. If you report it before 10th of Jan, it will be included in the following year. After 10th of Jan, if you report delay in reporting the tip income, it will be included in the 2022 tax year. This is the example which is mentioned over here. You can just quickly go through it. Okay, so December tip reported on or before 10th of Jan, included in the income in the month of Jan. Okay, taxable in the next year. But December tip which is reported after 10th of Jan, delay in reporting, it will be included in the income in the month of December and it will be taxable in 22 only. Okay, form 4137 will be given by the employee to the employer as a written report for all the cash tips. How the employee is going to report it to the employer? They will have to file a 4137 form with the employer. Okay, tips reported on the employer on the time are considered as an income in the month reported. Okay, and when it is reported in a delayed month, then it will be included as an income in which the tips are received. Okay, so here in our example, it was included in the December month, and if it is reported on time, then the month in which it is reported, it will be included as an income. Why I took so much time on this topic? Because SID tip income, there will be 1 or 2 questions which are very cash marks for you guys in exams. Okay, so just understand the difference between reporting and non-reporting of the tips in the tax return. Okay, for employment taxes, now whatever we have done, let's just revise it quickly. In case of fringe benefit, how it will be done? If you receive a accident and health benefits, then income tax withholding will be exempt. What do you mean by income tax withholding? Means federal income tax will not be deducted on accident and health insurance benefit which you receive. Then when you are going to receive the health and insurance health and accident benefit, no social security, no Medicare, no additional Medicare will be included. Exempt means it is not liable. FUTA will not be liable on the accident and health plan. Okay, exception is given, that is for a long-term care benefit provided through a flexible spending or a similar arrangement. We have already done the meaning in the class. This is just a revision lecture, so this purpose of this lecture is just to make you revise the topics which we have already done. I'm not going to take each and every topic in detail. Okay, so type of fringe benefits, if it's an accident or health benefit plan, it will be exempt from any withholding, it will be exempt from federal income tax, exempt from social security, Medicare and FUTA taxes. Achievement awards, now here it is up to 1600. Do you remember in prizes and awards we have done up to 1600 if it's a qualified plan? What was qualified plan? Which is same for all the employees, right? $1600 will be exempt. More than $600 if you're paying, then it will be taxable as an income, as a wage income for the employee. Okay, now 1600 was the total amount and $400 was for the non-qualified awards. Okay, $1600 was the total award. Out of that, 400 is for non-qualified plan and remaining amount will be allocated for a qualified plan. Okay, but the total award, achievement award amount is 1600. There were 2-3 more criteria which you have seen that in last 5 years the award should be given only once. Okay, more than once if you are going to receive, you don't receive this exception. Okay, up to $1600 you can get the achievement award. Okay, next is athletic facilities. If it is given by the employer to the employee on their organization, like at the infrastructure, then it is exempt from federal income tax, FUTA, and Medicare and Social Security tax. Okay, adoption assistance, if it is provided, then it is exempt from federal income tax, but for Medicare and Social Security, it is taxable, and FUTA also it is leviable. Okay, for adoption assistance, it happens that the employer will be providing some adoption assistance to the employees, then in that case these three things you have to consider. Okay, then we have de minimis benefits, small benefits like food, beverages which are provided at the time of your employment, tea, coffees is provided. So see, some de minimis amounts are all exempt from the federal Medicare and FUTA. Okay, dependent care assistance is exempt up to certain limit, which is 5,000. And if you remember our first session, if you file a MFS, this dependent care benefit will reduce to $2,500. And when you are going to get this dependent care benefit, what will happen is, when you are going to pay the dependent care expense, you remember the credit, dependent credit, right? All the qualified expense you will take, and you are going to reduce the dependent care assistance which has been provided by the employer to you, which is $5,000 or maybe 2,500. You are going to reduce it, and remaining amount only will be allowed as a credit. This we have already seen. So dependent care benefit, if it is provided by the employer to the employee up to 5,000, it is exempt from these three taxes. Okay, from federal income tax, Medicare, Social Security, and FUTA taxes. If you receive a educational assistance, okay, this was dependent, this was educational assistance. If you receive, it will be exempt up to 5,250 for each benefit for each year. Okay, employee discounts, if you are going to receive any employee discount, it will be exempt up to certain level. What is the limit? What is the limit? It will be mentioned. It is mentioned by the IRS that it will be excluded from your wages if that discount which is provided to you on the service is up to 20% of the price which is charged to the normal. So can I say up to 20% of the discount is allowed? Second thing, the employer don't have to incur any additional cost for giving that discount. Okay. Third is for discount on merchandise or other property, your gross profit percentage times the price you charge to non-employee customers for the property should be similar. Means maximum, just remember like this, maximum 20% discount the employer can provide to the employee. Let's say I'm working in any supermarket store. Okay, so in that store, if I want to buy certain products, I have an employee code, right? Using that, I can get a 20% discount. So that 20% discount which I'm going to get on that, I'm not going to charge, employer is not going to charge me any federal income tax, Medicare, Social Security, or FUTA taxes. Okay, this is what it is saying. Next is group term life insurance. We already saw it is exempt, right, from federal income tax, but it will be taxable if the cost is the coverage cost. Again, I'm mentioning coverage cost is different, cost of taking the insurance is different, and coverage is different. Okay, so you have to check the coverage amount. If it is more than 50,000 for all whole group, then the cost will be added as a wage income for the employee, and it will be taxable for medical and social security taxes. Okay, FUTA and FIT is not applicable, but Medicare and Social Security will be charged if the coverage goes more than 50,000. Okay. Next is health saving account. If employer is providing certain health saving account for the employee, then it is exempt for qualified individuals up to HSA contribution limit. We will see that when we do the HSA topic, right? Additional some adjustment to income, we'll see that topic in the adjustments to income. Over there it is mentioned that for calendar year 2023, qualifying HDHP means what? A qualified health saving account. If you're depositing certain amount, then it will be deducted up to 1,500 for self only coverage and 3,000 for a family coverage, and out of pocket expense allowed is 7,500 and 15,000. So don't worry right now, don't stress out on this topic. We'll do it again when we do the adjustment to income. The idea is just to make you understand, if employer is taking the health saving account for the employee, then federal income tax, Medicare, social security, FUTA taxes will not be leviable on this. That's why on W2 form, when you receive a W2 form, there is a box number 12 on the W2 form. On those items, social security, FUTA, federal income tax is not leviable is added on the box number 12 of your W2 form. Okay, those who are working practically, they might have seen the box number 12 over there. Okay, lodging on your business premises. Okay, so let's say the company has provided you a lodging facility. Let's say, for example, it's a tax season and the CPA firm has told that no one will go home, 15 days you will be living in the same organization over there. They'll give you some facilities to live over there for 15 days, but it should be for the business purpose. Okay, or let's say, second example, if they send you somewhere in the client meetings or some conferences, and that is for business purpose. So lodging on the business premises. Okay, let's say they send you some other state. Okay, let's say if your headquarter is in California, but now they are sending you in New Jersey. So in New Jersey, when they are sending you over there in the office premises only, in the designated premises, you are staying over there, completing the work for 10 days or 5 days, all the expenses are incurred by the organization. So lodging on the business premises will be exempt from the federal income tax. Again, I'll write it over here: federal income tax, social security and Medicare, and FUTA. Okay, got it, guys? Meals are exempt, is furnished on your business premises at for the employer's convenience. Let's say in the tax season, if employer is providing you some food, right, on Saturdays and Sundays, if you're working and they provide the meals, the dinner, the lunch they are being providing, then it is exempt because it is at the convenience of the employer at the business premises. Okay, no additional cost services. If extra something they are providing to you on for which they don't have to incur any additional cost, then it is exempt from federal income tax, social security and FUTA. Okay, retirement planning services. This is planning services. Okay, so they have hired a retirement planning company or an agency, and they are just providing them the services for educating them for how to save money and all. So that is exempt. Okay, transportation services will be exempt up to certain limits. If for rides in commuter highway vehicle, means employer is going to pay a fixed amount for your transportation. Okay, so how much will be exempt? Transit pass, if you are going to get up to $300, it will be exempt, or if you receive a qualified parking up to $300, it will be exempt. Okay, tuition reduction, if you are going to get, then it will be exempt. If you undergo education or certain research related activities which will be used in your business purpose. Okay, so that tuition fees which will be incurred, the sponsorship I can say, which will be incurred by the organization for you, will be exempt from any federal income tax, social security, Medicare and the FUTA taxes. Okay, working condition benefits. So let's say if they provide you certain benefits, that if you're working late nights, and for that you will be given this benefits. So all those extra benefit, working condition benefit, will be exempt from all these three. Okay, got it, guys? Additional point, you can just read it. It's just a simple I can say there were some changes as compared to 2021 and 22. So you can just read this additional point from your book. Next is special rules for certain employees. Now we are coming to the clergy employees. This is also an important. They will ask you at least 1 or 2 questions based on taxability of the wages of the church employee. Okay, clergy employee, for them what will happen, whatever they are going to earn, okay, if they are working in the church and they're not going to get any income or anything, then it doesn't matter. But if they are working in the church and they are going to receive a particular salary or fees for performing particular activities, right, for performing masses, marriages, baptism, funerals, then it will be liable as a wages. It will be added as a wage income. Now sometimes what happens, those ministers are there, they are called as ordained ministers. They receive housing and pension facilities also. The pension will be treated as a regular pension, okay, but in case of housing facilities, if they are going to receive the housing facilities like rental home, utilities, designated housing allowance, all will be excluded from the income. Means all this will not be included in their W2, right? It will not be included as a wages or salaries, but all this will be included as a Schedule C, as a self-employed income, and on this self-employment taxes will be applicable. if you have a church employee who is having income of more than 108.28, then mandatory you will have to pay the self-employment tax on the whole earnings which you are going to earn from the church. Okay, and this is applicable only in case of service rendered as an ordained or licensed or commissioned minister. Got it, guys? This is simple. You just have to check whether a person is going to get any housing facility then included in Schedule C, whether a person is going to receive any amount directly from the church, okay, included as a income. Now there can be two things which can be done by the that ordained minister: service performed for the order and service performed outside the order. If the services are performed for the order, then the wages, it will be included as a wages a member earns as an agent for an order, and turns over to the order are not included in the income. Means if you are performing the services based on the order of the church, okay, and whatever income you are going to earn, the whole income is going to be given back to the church, so it will not be included in the wages, okay. But service performed outside the order, let's say you are just working somewhere as a tax preparer, or just as a some consultant or advocate, or somewhere as a legal, or anywhere you are working, but that is outside the service, outside the order of the church, okay. Church has not ordered you to perform this service and perform that service. And then when you're earning certain amount, let's say you are earning $1,000, out of that $200 you are keeping with yourself, and the whole $800 you are giving it to the church. That doesn't mean that whole $1,000 is exempt from the taxes. The $1,000 will be leviable to wage, income will be chargeable to tax, because you are performing service outside the order. This $800 which you are then donating to that church, going to deposit that amount to the church, will be considered as a charitable contribution, okay. So it is mentioned here, the whole $1,000 will be included in the income. The exception is services that are ordinarily the duties of the members of the order, okay, plus they are the part of duties that the member must exercise for religious order, okay. Let's say there is a particular facility at the church. On every Friday they used to serve the needy people the food and clothing and everything, okay. So you are just servicing over there on behalf of the church, okay. So that thing on behalf of the church, and if you are receiving any donation or anything, right, for that food and clothing for any third party, then that will not be your income. That is directly going to be a part of the church donation, okay. But let's say you are earning some income on your own skill, okay, based on your skills, and you're working somewhere, and whatever income you're earning, although you're going to deposit certain amount to the church, $800, this $1,000 first will be fully taxable, and then for $800 which you are depositing, you can get the charitable deduction for that amount, okay. That is the definition of the clergy, how the treatment will be done in case of clergy and the member of religious orders. For foreign employers and employees, we'll do it tomorrow when we start the foreign transaction, foreign related topic, okay. Military pay, when you being a military employee, when you receive any amount, you will have to report the payment received as a service member as a wages. You'll have to report it as a wages for the tax purpose, except for any retirement pay which is taxable as a pension. Only retirement pay which you are going to receive will be taxable as a pension, right? After you retire from the military services, you start receiving the pension, that will be taxable as a pension income on your 1040 form only. But when you receive during the time of services, any payment received will be included as a normal treatment, that is W2 wage income. Got it, guys? This is for certain different types of employer. Only the foreign employer will do it later on, together with the foreign tax credit and foreign on income exclusion. Next is, guys, interest income. We still have 30 minutes, and I hope we can complete the gross income topic today, so that tomorrow we're left with the other topics. Interest income will include certain amount which will be taxable and certain amount which will not be taxable. First, let's see what is non-taxable. Non-taxable, but it will be included on 1040 form. Do you remember on 1040 form you have line 2A, line 2B, 3A, 3B. So the inner line is non-taxable, the outer line is taxable. So right now, what will be the non-taxable interest income if it is received to you by a municipal bond, that is state or local government. Federal municipal bond is taxable. They will twist these words in the exam. Federal related bonds are taxable, guys. Only and only state and local related bonds, local government bonds are exempt. Okay, so those interest income which you are going to receive from that kind of bond, which is a state or a local government bond, that will be exempt. Second type of interest will be exempt if you receive it Series EE bond. Means if you use this bond, these are the Series EE bond, the amount when you redeemed the amount from this bond, and if it is used for qualified purpose. What is the qualified purpose for Series EE bond? It is higher education. When you get the redemption amount, okay, or you get the interest amount, any amount which you receive from this Series EE bond is used for the higher education purpose, this will be exempt. So only these two exceptions are there where interest income will be exempt. Interest income will be shown on a form 1099B, and in the tax return it will be shown on the schedule B. Okay, so what is the limit, like when it will be taxable? If you receive an interest income of more than $1,500, it will be taxable, and in some cases it will be more than $10 and more than $20. We'll see that over here. The taxability is mentioned on the left side. Interest on federal bonds, as I mentioned, if it's a state and local government, then it will be exempt, but on federal bond it will be taxable. Premium received on opening the account. So this $10 and $20 is regarding the opening the bank account. So what is this? Over there in US, they'll give you a premium. Let's say they'll say you deposit $5,000, you'll get an opening balance of $5,020. So the $20 extra which you get in your account now, it is a premium which you are receiving for opening a bank account. Okay, so that premium which you are going to receive is your interest income. Third one is interest for the late payment of the tax refund. When you are going to receive a refund, and if the federal or the state or the local government fails to pay you the refund on time, they will also pay you the interest. So for that you receive a 1099G. In that interest column is mentioned with an amount that on this refund you have received this much interest. Okay, so whatever interest you are going to receive from even from the federal government for the refund amount will be added as a interest income. Interest on the deferred payout arrangement means what? When a person dies, right, his insurance policy gets matured. Now it's not possible for the beneficiary to take out the whole insurance amount and utilize it. So what they will do, they will take that insurance amount in let's say 3 months, 4 months, in different installments, they are going to withdraw the amount. So till the time whatever earnings are there on the interest income, it will be included as a interest income by way of interest on deferred payout arrangement. Here one example is there. Mr. X dies, but this nominee gets the amount. Okay, so if the nominee has the option that they can get the $1 million today, or they can accumulate it within next 20 days. They are not going to use the whole $1 million on the same day. So what they did is they had the option to accumulate the whole $1 million for 20 years. So after 20 years, you will not receive the exact 1 million. There is a time value of money, right? So you are going to receive $1.2 million. So extra $0.2 million which you are going to receive is your deferred payout. Even though you are getting it as a lump sum, after 20 years, the whole $0.2 million is your interest income, and it will be included in your schedule B as a interest income, interest on deferred payout, I will say. Okay, interest for seller financed mortgage means let's say I am selling my property. Okay, I'm selling it to some other person on an installment basis. So while I'm giving it in the installment basis, I will be charging certain interest on that, right? So that interest which is financed by the seller, and the seller, it is a seller financed mortgage, that interest income I'll include it in the schedule B, and rest all amount which I'm going to get as an installment, I'll bifurcate it between the cost basis and the selling price basis. If you remember, we have done that installment sales, right? First remove the whole interest amount, include it on the schedule B. Whatever is the remaining, will bifurcate it between the cost and the selling price. Cost will not be charged to capital gain, but the remaining profit percentage, GP percentage, if you remember, right, will be charged as a income, as a capital gain. Got it, guys? Next is original issue discount. Now this will happen in case of if you receive a bond and the redemption value is higher. In that case you have the extra benefit, right? So that OID, original issue discount, let's say one of the bond has been issued at $98, but when it is getting redeemed, it is redeemed at $150. So what is the case over here is the extra amount which you are going to get at the time of redemption is your benefit. So you will have to include it as the interest income. But there is one condition, and remember this is important. There will be one question on this topic. You have to apply the formula. What is the redemption value of that particular shares or security or bond? Okay, take the redemption value, reduce the issue price, which is 90 in our case. Whatever is the difference, if it is up to this amount, what is the amount? Redemption value, that is $150 into 1% into number of years the bond was having the life of, let's say 10 years or 5 years, multiply the number of years, multiply by 0.25. Okay, first of all, when you receive this type of question, now first calculate this thing. Okay, redemption amount into 1% into number of years into 0.25. If your redemption value minus issue price, if it is up to this value, then no need to make it taxable. It's a exempt interest. But you receive the benefit of more than this, more than what? Redemption value into 1% into years into 0.25. More than that, this if you receive the amount, right? Here, the second scenario will apply. If you receive more than this, what is the value? Redemption minus issue price, it will be taxable. And capital gains will be chargeable at the time of maturity. At the time of taking this type of bond, you will be charging the interest income, and when you sell this type of bond, at that time you will be paying a capital gain tax later on. Okay, now here one more thing I missed was, in case of interest income, you know, sometimes it happened that two people are having the account as a joint account, okay, in one bank. So it's called as joint saving account in the name of one taxpayer, right? They are going to receive a 1099 INT, right? Interest income. So let's say me and my sister are holding the bank account in joint, right? And whenever they're going to pay the interest, they will issue a 1099 INT in my name, because maybe I am the primary holder. So in my name, they have issued the INT. But this interest income is having equal rights for me and my sister, right? So what will happen is, I will have to pay her share to her, and also I will be issuing 1099 INT to her as a payment made to her. Okay, so only my portion will be taxable in my return, her portion will be taxable in her return. So that is what it is mentioned. In case of nominees, this will happen. Okay, in case of joint return. Next is dividend and other corporate distribution. This is very simple to understand. I know that there is a lot of theory in our book, from the class notes. Please do read the theory, but right now just understand the quick concept, which will be helpful in solving the exam questions. Okay, see, dividend will be taxable or non-taxable, or it can be considered as a capital gain distribution, or one more is a qualified dividend. This we'll do later. Like first, let's do first 3 points. Either it can be taxable, either it can be non-taxable, or either there can be a capital gain distribution on the dividend. When it will be taxable, when you receive a cash or kind distribution out of the retained earning. This is the normal dividend. Layman's language, when you receive a distribution from the retained earning. Retained earning means the profit of the company. When you receive a distribution, that is your ordinary income. For this, you will be receiving 1099 DIV from the company. You will be including it as a ordinary income in your tax return. Okay, now let's read the capital gain one. Okay, when you're going to receive distribution which is more than the face value. Okay, so difference between the face value and the amount of distribution will be your capital gains. Means, let's say my face value was $100, okay, $100, and I'm going to receive a dividend of $110. So up to $100, it will be recorded as an ordinary income, that is taxable. The extra $10 which I'm going to receive will be considered as my capital gain. This is what it is saying, and it will be chargeable at a capital gain tax rate 0%, 15%, 20%. Okay, we'll see that later on. Well, the second one is non-taxable, that is called as a tax-free dividend. Okay, means what? Return of capital up to the amount you are putting into the company. Okay, up to that amount it is tax free dividend. These normally happens in case of corporations when you're going to receive a distribution at the time of closure of company, liquidation of a company. At that time, whenever you're going to receive it, it is a non-taxable or a tax-free dividend. As soon as now your distribution goes higher than the basis, I can say, then it will be taxable as a capital gain. Okay, return of capital up to the amount put in the company. Second one in this is stock split and stock dividend. It is totally non-taxable, and most important is this point only in this whole topic, dividend topic. Stock split and stock dividend is the important topic, where see what will happen whenever let's say I have 5 shares of $10. So can I say my value of all these 5 shares is $50, right? So now what will happen on this 5 share, I receive a stock split. One share, I receive a stock split for 1 share for 1 existing share. So what will happen? For 10 shares, I'm not going to recount the per price, per share cost, but this $50 will be carried over here same as it is. Only the per price will get changed, that I will consider it as a $5. My stock splitting is done, but the cost of the total cost will remain same. Only I have to split is per share cost, like this. Okay, that is stock split. Same way stock dividend. Stock dividend, we have few criterias, we'll see over here. Yeah, stock and stock rights if you're going to receive, right? And if it is only for common stock, then only it is non-taxable. The question will be straight away, one theory question will be there based on this topic. Stock and stock rights, only common stock are there now, then it is non-taxable. If you have the option to buy either common or preferred, then it will be wholly taxable, right? If you have the option to buy only preferred stock, then it will be taxable. Here the taxability is there. Okay, dividend, whether it will be taxable or non-taxable, what we did is that it will be non-taxable. But if it's a stock dividend, and if you receive that stock dividend for the option of common stock, then only it will be non-taxable. If it is for preferred plus common, or you have the option to buy either preferred or common, or you have option to buy only preferred stock, then all 3 cases it will be taxable. Okay, got it guys? I hope everyone is understanding this. Third, the last point is qualified dividend. What do you mean by qualified dividend? It is if it is paid by the US corporation or a qualified foreign corporation, and if you are holding the stock for at least more than 60 days, out of 121 days starting from this day, means out of total 121 days starting from the 60 days previous to the ex-dividend date. Let me explain it again. See, if you are holding a stock for at least 60 days, right, out of 121 days. Now, this 121 days will be starting from 60 days previous to the ex-dividend date. This is a dividend date, okay? Now, this dividend date, from that you have to previous calculate 60 days. So, this will be your total 121 days. Within this 121 days, if you are holding the stock for at least 60 days, plus the dividend is paid by the US corporation or a qualified foreign corporation, then it will be called as a qualified dividend. On this, the tax rate applicable will be 10, 15, 20. If you have seen the tax slab rate for a normal individual, the slab rate will be 20%, 22%, 25%, 27%, 37%. It will go, it's very huge slab rate which will go maximum to 37%. So there you have to check that those who are having a slab rate of 0 to 10%, maximum 10% will be applicable for qualified dividend. If you have a slab rate from 11 to 15%, you will have to apply maximum 15% on that tax as a qualified dividend tax rate. More than 15%, whatever is your slab rate, you have to check on which slab rate you are falling. If it is more than 15, even if it is 25, 27, 37, maximum qualified dividend tax rate will be 20%. This is what the tax rate which will be used for qualified dividend, that is special tax rate. Same concept is there in case of capital gain. When we do the capital gain topic, property transaction topic, there we will see that 0%, 15%, 20% tax rate are there for a long-term capital gain. For short-term capital gain tax rate are not applicable. Guys, remember, if you have done the session lectures, you might have understood that topic. Short term capital gain is your ordinary gain tax rate will be applicable. For long term capital gain, these three types of tax rate will be applicable, and how they will be applicable, that will based on which slab you are falling. Okay, 0% or maybe 15%, 20%, 22%, 25, 27, 37, whatever is the percentage, you are going to take the lowest one. Okay, let's say if it's more than 15, you have to take 15. More than 20, maximum 20 only you will charge, not as an ordinary tax rate. That is the benefit of a qualified dividend. Dividend will be chargeable to tax if it's a normal cash or kind distributions out of the retained earning. If it is more than your face value, it will be called as a capital gain distribution. If it's a capital gain distribution, capital gain tax rate will be applicable, right? When it will be not taxable, if it's a stock split, stock dividend, only common stock will be taken. Preferred or the combination of both will not be taken. And if it's a return of capital, means let's say you have invested $100 into 50, so $5,000. When the company is getting liquidated or shut down, then when you are going to receive a distribution up to your basis amount, it is a return of capital, right? So it will be not taxable. More than that, it will be called as a capital gain distribution. Got it, guys? I hope dividend is clear. IRA we have already done yesterday. Now only two small topics are left. I'll take it quickly. Social security is also done. Rental income. See, rental income is very simple. You have to check that when you're going to receive a rent income, right, you have to make it chargeable to tax in your Schedule E. Schedule E will be, showing all your gross rental income, any prepaid rental income, right? Non-refundable deposits are there, plus any improvements you are making in the lien of rent. Means if a person who is going to instead of paying you rent, they made some improvements in your rental income, at your home. Okay, so improvements instead of paying you rent, that will be also considered as a rental income. Any amount received for the tenant which will be paid by the taxpayer, let's say rental real estate taxes, which should be paid by the owner, but now it is paid by the person who is living in the house, right? So all the real estate taxes will be added as an income first, and then from the rental expense it will get reduced. All the rental related expense, means any repairs, maintenance, utilities, any amount of taxes which you are going to pay will be reduced as a rental expense. Okay, so this is the amount which you will receive is a net rental income or loss. Now this, since day one I'm mentioning rent is a passive activity. It's a passive income. So it can be offset. Let's say there is a loss. So this loss can be offset against only and only passive income, not against the ordinary income. But we have one exception. IRS has came up with the law that if you follow this rule, then this passive loss can be offset against the ordinary income, else it is not allowed. Okay, what is the rules? Let's say if you have rented your property for less than 15 days, right, and you are going to regard this rental property as a deemed personal property, means it will not be called as a renting business, it is a personal property. In that case, whatever rent you are going to receive for less than 15 days you have rented, right, so whatever rental income you have received, it will not be chargeable to income. No taxes will allowed to be deducted. No deduction will be allowed for depreciation or any other expense. Only and only municipal taxes, means real estate taxes and mortgage interest, will be allowed to be taken on a Schedule A. Because we have seen, like we will see in the upcoming revision lectures, but in regular class you might have seen Schedule A is all related to your this personal related expense. Some personal expense are allowed. One of them is your real estate taxes and mortgage interest. So these two amounts you can deduct easily from your Schedule A if you have rented the property for less than 15 days. Okay, now if you have rented the property for more than 15 days, then there the situation will come that when you are going to offset your loss. Okay, if you have rented the property for more than 15 days, what will happen? And it is also used for personal purpose. Now you have to check till what time have you used the property for the personal purpose. Is it used for more than 14 days or more than 10% of the rented days? Let's say during the whole year 365 days, I have rented my property for 300 days. So 300 into 10% is what? 30 days. Whether I have used the property for personal use for 30 days or more than 14 days. If yes, then it will be deemed as a personal cum real property. Means whatever income I'm going to earn, I'll have to allocate it between the personal use days and the rented days. Personal use days, whatever is amount allocated to personal use days, that will not be added as a income, but against that rental loss will also be not allowed, or no expense will be allowed. You have to proportionate your rental property between the personal use days and the business days. Now what will happen? Whatever is the rental expense which can be deducted will include insurance premium paid on advance is non deductible. Insurance premium, remember this thing, advance, if you're paying insurance premium for your property, it will not be deductible. Cost of repair, yes, it is deductible as an expense. Any improvement which you're making for, or any expense that you are using to increase the value of the property, means any capital expense if you're making, we will apply de minimis rule. Okay, what is de minimis safe harbor rule? That up to 2500 you will expense it off in P&L. If you incur more than this amount, you are going to include it as the asset, and on that you can claim easily the depreciation expense. Okay, and for cost of improvement, it should be more than $200, and any additional part you are adding, it should be more than $2500 to add it as a capital expense. It will not be deductible, means it will be added as a capital expense. Okay, now let's see, in case of rental activity loss, it should be set off only and only against passive income. We still have 6 minutes, we'll complete the rental property topic. Okay, so can be set off against ordinary only and only if you are working for more than 50% of work is involved in real property and your participation is more than 750 hours. Means you are actively participating in the Schedule E business, then only you will be able to offset your rental losses against the ordinary loss. But the condition is, you have to see this condition. There will be one question on this. They will provide you a lot of conditions. You have to check whether you are devoting more than 50%. 50% of work is involved in real property and your participation is at least 750 hours. Plus the loss which is there, when you calculate this, the loss has to be less than 25,000. Then up to 25, see they have given the limit. Up to 25,000 only you can deduct as a rental loss from your ordinary income. Okay, so rental loss up to 25,000 can be deducted, and both spouse should actively participate. Now here the phase out limit will come into consideration. If your modified AGI is up to 1 lakh, the whole 25,000 loss you can deduct. Okay, 25,000 or actual amount of loss, not the whole flat amount is not there. It is whichever is lower. You can deduct it against the ordinary income. You can set off against the ordinary income, and the remaining loss will be set off against the passive income. Okay, and then remaining will get carried forward to the upcoming years. Now this is the condition. If your modified AGI is more than 1 lakh, what will happen? Maximum deduction will be ordinary income. From that you are going to get a maximum deduction of whichever is lower. What? Let's say 1,50,000 is the highest limit. See, from 1 lakh to 150,000, if you are having a modified AGI, then you can get a reduced set off. But if you are having an amount of modified AGI of more than 150,000, you can't set off any amount of rental loss against ordinary income. So what you are going to do, take 150,000, reduce the actual modified AGI which you are having, multiply it by 50%. Okay, so this is the phase out limit which you need to calculate, that you are going to compare with the 25,000. Whichever is lower, you are going to reduce that much amount from your ordinary income. Okay, so the first you will reduce against ordinary income. Second, you are going to reduce the remaining loss against the passive income, and remaining, if you have any, will be carried forward to the next years. Okay, now here one more deduction you are going to get is auto expense. If you are expensing, if you're using your car or vehicle for rental purpose, then it will be reduced based on the standard mileage. or actual mileage, actual expense, right? Actual fuel expense which you're incurring, you can either take that deduction or you can take a standard mileage as a deduction. What is the standard mileage for 2022 tax year? From Jan to 30th June, whatever mileage you have used the vehicle, multiply it by 58.5 cent per mile, and then from the next 6 months it will be 62.5 cent per mile. Okay, total it up, and up to that much amount you can take it as a standard deduction for the mileage. Okay, next is business income and loss. We'll do it in the later session. Let me first check our schedule. Okay, so tomorrow actually we are going to start with the foreign related, all the incomes and all. When we do this now on 20th September, see, unearned income is done, stock dividend is done, stock split is done. Over here I'll take the schedule C again. Okay, schedule E is done, all the unearned income is done, interest is done, dividend is done, stock dividend, stock split is done. Schedule C is left, we will take it over here, but tomorrow we'll be starting with the foreign income. Don't miss tomorrow's session, guys, please. Those who are also watching the recorded session, for them also I'm talking that it might be possible the next 3 days session will get delayed in uploading on the YouTube. So please make sure to attend the live session if possible. Okay, anyways, those who have not received the book, please ping me in personal. Already that has been dispatched, but in case there is a delay, I'll just check from my side. Okay, guys, thank you so much. Have a good day, and please keep on solving a lot of MCQs. Please keep on revising on daily basis. There is not much time left. Those who are having exams in October, please read it on daily basis. Okay, do follow the same sequence for easy understanding. Okay, so yeah, thank you guys. Have a good day.